Good afternoon. I'm Brad Rathe, partner, senior director of portfolio management at Waverly Advisors, and today I'm joined by John Cox.
Hi, I'm John Cox, Chief Investment Officer of Public Markets at Waverly Advisors.
Thank you for tuning in to another edition of the monthly market roll, where we provide a look back at the economy, markets, investments, and other macroeconomic data for last month, and then we roll forward to this month and give our insights and what we think is coming up in the markets. So I'd say, John, let's get right into it. Give me a little bit of your general view and what you've seen in the market so far, this year, and especially, recently with the quick bounce back in the markets this month.
Yeah, so the first quarter of the year was strong for both economic data and the markets. And then we had a little bit of a pullback in April, which was kind of a healthy situation for the markets. We had been on a streak of 5 straight positive months. So April in general was down about 5% for the equity markets. But then we bounced back in May and essentially made back the April losses in May. And the economic data has softened a little bit in terms of job growth, in terms of the inflation number, and some other factors that we look at, oil prices, things like that. And that's actually a good thing for the Federal Reserve as they look to the next Fed rate cut, which could come in September, not likely to come in June or July at the next two meetings, and then September, and then the one after that would be November. So still a potential for 1 to 2 rate cuts this year, which would be good for the markets. Markets typically rally after the first rate cut, not always, but more times than not. So things are really kind of moving in the right direction. Just like always, there can be situations that we're not expecting, whether it's something in commercial real estate, whether it's some kind of trade friction with China or some other big economy. But for now, things are heading in the right direction.
Really feels like the Fed is the only game in town again, right? That was kind of what it was forever. It feels like it's almost getting back to a little bit of that. Is that kind of what you're feeling? And I'm going to bring up the slides while you're talking about it. But that seems to be a little bit, and a lot of questions we get, and it's almost getting irritating that that's all we talk about, right? Is the Fed and the only game in town. What are they doing? What are they doing next? When are they not doing it? Give me a little on that. Is that kind of what you're seeing too, or how are you looking at that right now?
Well, yes, and it can be confusing for the markets because you get some Fed presidents or Fed governors who comment on inflation or the economy or the potential for rate cuts, and they may say something that's a little bit of an outlier relative to the overall kind of Fed messaging. So, and that could sometimes kind of move the markets. But I think we had 3 straight months of higher inflation prints, and then the last month, or actually in April, the inflation number was in line and it was a little better than expected in the previous 3 months. So that put it back on the table that we could have those rate cuts later in the year. We have another inflation number that comes out next week. Jobs number will come out soon. And I believe if the Fed sees that the economy is continuing to do well, but it's not overheated, then the likelihood of a rate cut will increase. And I think the markets will respond to that in a favorable way.
What you can see here, the weird thing is we haven't moved in, I think, 9 meetings, right? This is one of the longest times that we've set at the same rate, this 5.5. But you've seen markets all over the place, even though rates really haven't moved. It's just all this expectation, right, around what they think is going to happen. And we've gone from thinking there was going to be 6 rate cuts to down to, is there going to be a rate increase? And I think that's what this was. There was almost getting to the point in the markets, they were saying there's going to be a rate increase. And I think he put that at bay and the market took off. And again, kind of this idea back to the Fed, and such an important thing to remember and look at. And obviously, I think on Friday we have the job number. Today we had the ECB. We'll talk about that a little bit later, but it does seem like this idea around Fed seems to be such a big driver in the market. But it did drive the market to 40,000. You had lots of people talk about this. We always talk that this is somewhat of a flawed index, right? When you look at this versus S&P, what do you look at when you're looking at markets, and which index is important to you? And I've always thought the Dow has, we call it 1896 math just because it's off a price. What do you look at when you're looking at indexes and thinking about how performance is?
Yeah, the Dow is definitely the most widely quoted index and goes back for many, many decades. But it is price weighted. So if a company has a $300 stock price, it's more heavily weighted than a company that has a $100 stock price. Even though the company that has the $300 stock price, their market value might be actually less when you factor in their number of shares. So it definitely is a sort of an outdated type of index, but it's what most people know. The S&P 500 is weighted by stock market value. So companies like Apple and Microsoft and Nvidia are going to be the top holdings. They're going to have a disproportionate impact on the index in terms of performance. You can look at equal weighted indexes, which might be a good indication of how the overall market is doing. If you take the 500, the S&P 500 stocks and just look at them on an equal weighted basis, then you can see if the market rally is broad or if it's really concentrated in just a handful of stocks. So there's a number of different indexes that you can look at. Russell 2000 is primarily used for small cap stocks, and then you have international indices. But for the U.S., even though most people pay more attention to the Dow, probably the S&P 500 is more relevant.
Well, and this comes back to what you just talked about, different indexes and looking at it inside. And one of the things that a lot of people talk about is this idea of value versus growth. And it's been a really, really good diversifier, right? If you go back to, what was it, 22, where value outperformed growth significantly. Now, the last little while, you've seen growth significantly. I think it's like almost 10%. What do you think of growth versus value, and how do you, when you're putting together portfolios, what do you think about, and how do you put this together with all the the deviation you've seen in growth versus value the last couple of years?
Yeah, it has been more momentum driven. So companies like Nvidia that does the artificial intelligence, the chips, and the data centers, they are included in those growth indexes. And Nvidia's market value's gone from like $1 trillion to $3 trillion. They're now just as big as Apple. And just a couple of years ago, most people probably had not even heard of Nvidia, but they have now because they've become the second largest company in the world behind Microsoft at this point. So there will be periods of time where growth does extremely well, and it's a little bit more, kind of momentum driven. The value orientation tends to favor financials, bank stocks, energy, industrials. It can be those sectors can do well when there's a turn in the economy, when you really start to see some acceleration. So each one of those styles will have its time to shine. The period from 2000 to 09 was not a great period for growth stocks, but was really, really good for value stocks. The more recent period, it's been reversed. So it will go in kind of fits and starts. But for now, growth is in the lead. But again, these things can change quickly.
Yeah, no, I think having that balance, and I know in our portfolios with clients, are always thinking about how do you balance growth and value? And obviously, you talk about large cap, mid cap, international. We're looking at all those types of factors, and I think understanding how they move. And I love your point on momentum and thinking about how momentum is moving, and that normally it is a bit longer term. It's not like this momentum of we're certainly not looking at momentum over a month. We're looking at momentum over years, 2, 3, 5 year type of momentum, and it's been there. So you can use that in portfolio construction, and something we look at. I think the other thing, just thinking about business cycle and how things move, I always like to look inside the hood, not just the indexes we started here, S&P. You were looking growth value, but the other way is looking inside in sectors. I think the interesting part this year, I think most people would be stunned, is utilities are that leading sector, and technology, I think, is like the fifth sector. Again, just trying to think about how you portfolio construct. What do you see from the inside of sectors? And I know we don't play sector necessarily, but I think there's good information here to be able to put together portfolios. What are you seeing right now when you look inside or under the hood? To say with what's going on.
Yeah, I mean, from a contrarian perspective, you look at what is underperformed and what might be poised to do well when we look over the next 1, 2, 3 years, and it's real estate or publicly traded REITs, and they've been kind of brought down with private REIT holdings or private real estate holdings because of the struggles in the office market and retail real estate and other areas. But they have become much more attractive with the declines that they've experienced over the last couple of years. Utilities have been somewhat out of favor until recently. Interest rates have stabilized, and that's caused utilities to go up in value. They produce a good, steady income, which is something that investors appreciate. Healthcare has been another area that's been a little bit out of favor. There have been a few sectors of healthcare that have done really well, but for the most part, it's been technology, communication services, and sectors like that. So you're going to see a rotation. Obviously, if we looked, month to month, you'll see a little bit of change
I
and
see.
certain ones will, be at the bottom one month and then they'll rotate up to the top. But technology, consumer discretionary, communication services, those are more the growth sectors. And so overall, those have been the best performers.
Similar to balance, right? And thinking about, and we look at all these areas and it moves around, but I think this is the same type of thing. We look at it as style box, right? You have value, growth, blend, large, small, in mid cap. All these are things when we're looking at portfolio construction. How do we put all this together? We went from index to sector to inside of different size. And obviously, the flip side of that is on the fixed income side. You and I have talked a lot about this and become a little bit more excited about fixed income. Just when you have rates at 5.5 as a starting point, you actually had a reasonable return in May in fixed income. What are you seeing in fixed income? What gives you some optimism, or what's your thoughts around fixed income when you think about portfolio construction and all the things that we do?
Yeah, I think in fixed income and the bond index is down roughly 2% for the year. So it hasn't been a great year if you owned the index, which has a lot of treasuries. It's a little bit longer duration. So it's, bonds that are maturities of kind of 10 years and beyond. It has mortgages and it has some investment grade corporate bonds. But there have been sectors of the bond market that have done much better and that are actually positive this year. So investment advisor needs to look for areas that might be positioned better than the broad market index. And we've uncovered a number of strategies that have done well in spite of interest rates kind of going up and down over the last few months.
So, John, now we're rolling into June, kind of almost at the midpoint. It's been a good start to the year up to this point. Let's think about rolling into the rest of the year. What are we seeing? I think the key one for me anyway is this idea of kind of sticky inflation. And what I put on here is this idea that if there's what's rolling off, you have 1 year and it rolls forward every month, and you can see the stuff that's going to roll off the next 3 months are relatively low numbers. And
Right.
so it's going to be very difficult to bring down inflation over the next 2, 3 months. And what's your idea on inflation and where you see it going and how that's going to be impactful? Because I think that's probably the biggest concern I think investors have right now, and is inflation and how it's impacting their budgets and going to the grocery store, which is pretty frightful. I was there the other day, and it's crazy how much you can spend at the grocery store quickly. And give me a little bit on your thoughts around inflation and sticky inflation and what's happening there.
Yep. Well, one thing, oil prices have come down pretty significantly, and that will eventually lead to gas prices at the pump coming down. Hopefully, get below $3 a gallon in most states. But inflation should be looked at not only in one monthly data point, but let's look at the trend: 3 months, 6 months, 9 months, 12 months, and the trend is definitely favoring a decline in inflation and getting closer to where the Federal Reserve wants it to be at kind of in the low twos. I don't know if we get all the way to 2% anytime soon, but I think if we get sub, call it 2.5%, then the Fed will feel confident that the plan is in place and they can continue to lower or they can begin lowering interest rates. So again, like you said, the comparisons from last year are not going to be too favorable for the next month or two, but by the year end, if we don't see inflation, kind of in that 2.5 to 3% range, then the Fed might have to rethink what rate cuts look like for 2025. I don't think that's a likely scenario. I think the inflation does behave over these next few months. There's a rent component of inflation, a housing component that has been a little bit elevated and artificially inflated and elevated, and it'll start to come down later in 2024. That's going to bring inflation down even more. So I think we're in a good spot. I think Jay Powell got a lot of criticism. The Fed chair got a lot of criticism for being late to raising interest rates back in 2021, 2022, when inflation started taking off. So I don't think he wants to be accused of cutting rates too soon. I think he wants to make sure that the job is done before that process starts so that he's not criticized again. So I think they may be a little more patient than we want them to be, which means we probably don't get a rate cut in June or July. It's possible, but really not likely. September would be the month that everybody's looking at, and then again, there are Fed rate meetings in after the election in November and December. So it's possible that we get 3 rate cuts. Not likely. I would say 2 would be great this year, and then maybe we're on pace for every other meeting next year, which would be about 4 rate cuts next year.
The other thing that I know we talked about, it's kind of similar to one of the other graphs, is this idea of equal weighted. You went through that and how equal weighted is underperformed in this concentration risk. And I think it's come back a little bit, but I think it's a lot better this year than it has over the last couple of years. What's your feeling on concentration risk? How do you look at that? How does that factor into, when you're, putting together portfolios?
When the markets were responding negatively to inflation, kind of everything came down together. So some of these high flying stocks now that have done so well, like NVIDIA, were down 50, 60, 70% in
Yeah.
2022. Then they bounced back in 2023. And those, they call them the Magnificent Seven stocks, including those that we've already mentioned, they did so much better than the rest of the stock market. That can go on for a period of time. It can't really go on for a long, extended period of time. So I think we'll get to a point in the not too distant future where investors start looking beyond just those top holdings that we've mentioned, like Microsoft and Nvidia and Alphabet or Google, and start looking for stocks that offer more value, higher dividend yields, more growth, potentially some good growth potential. But you just have to be patient as an investor. There will be times like this where there's a little bit of mania or a lot of hype with some of the high flying stocks, and it's tempting to sort of jump on board, but it's typically not the right thing to do. It's a little bit too late in the cycle to do that. So we would say stay with a diversified portfolio, have some exposure to small to mid cap stocks, have some exposure to international, have fixed income if you need to dampen the volatility of the portfolio.
Well, and you just brought up international, and that was kind of the next area to think about. And obviously, the dollar's been extremely strong the last 10 years. I think it's 4 to 5% a year for the last 10 years. And you had Euro cut, the ECB, or the European Central Bank, cut rates by 25 basis points today. That not necessarily is going to hurt the dollar particularly, but this is definitely something to think about when you're, again, everything today, we got to talk about portfolio construction, but the dollar is such a big player, and when you're thinking about how much international you want to have. And so this is something that I know we look at, thinking about international, thinking about emerging markets and how the currency impacts that, how interest rates. So lately the dollar has been a little bit weaker, but I think it comes down to European growth, interest rate expectations. All those come into play when we're trying to put together a portfolio and using international. And this would be the last graph, and then we're going to wrap it up. But this is just a comparison of this year to last year. And I think most people would be a little bit shocked to know that this year and last year, we're almost at the exact same spot we were this year to last year. What are you thinking the rest of the year? How are you feeling about the rest of the year? And then just talk a little bit about where you're at with just your overall sentiment on markets, portfolio construction, things of that nature, as we try to wrap this up today.
Yeah, I think the difference in this time in 2023 and where we are today is that there's a little more enthusiasm and optimism about corporate earnings. So last year, corporate earnings were just getting back on track from a poor year prior to that. Now the expectation is that we could have 10% growth in corporate earnings this year and potentially more than that next year in 2025. Markets are forward looking. So yes, we're concerned about how corporate profits shape up in 2024, but we're also already looking out at 2025. So I think that bodes well for the markets. I think usually the second half of an election year is positive, not every time, but most of the time. So that could be, we're almost entering the second half of the year at this point. The second quarter GDP, which we're now closing in on the end of the second quarter, is projected to be right now at about 2.6%. There was just an update in that number today. That is a solid number, but it's not too strong. It's kind of one of those right in the middle of the fairway numbers. GDP growth in the first quarter was only 1.3%, so it was lower than expected. So if we could get something in kind of the 2 to 3% range for second quarter, I think markets would embrace that. Yeah. So I think there's a lot of positives. Again, we don't want to ignore the negatives out there. Again, we don't know what's lurking in regional banks when it comes to commercial real estate loan exposure. Occasionally we'll hear a bad earnings report, and markets will respond to that. I mentioned, kind of trade friction with China and other countries. That was, if you think back to 2018, that was what caused some problems with market volatility back then related to tariffs and other things. So there definitely there are some things to worry about, but I think the positives outweigh the negatives in this particular environment, especially for investors who have a 3 to 5 year time horizon. Things can happen within 6 months or 12 months that are unpredictable, but if you have that 3 to 5 year horizon, and the environment is positive, then you'll be rewarded as an equity investor and, like you mentioned, as a bond investor.
John, that was great. And thank you for your leadership. And we have such a great team now with all different diversified of opinions, and they're bringing that to you and the whole team. And I think I'm really pretty proud, I think, this year of what we've done and obviously what we can do the rest of the year. But obviously, we're always looking at risk. We're always looking at opportunities. But I think you've done a phenomenal job this year, just really pulling together this team. And so
Yeah, I couldn't agree more. Very super proud of the team.
Yeah, no, I mean, it's really been great.
Any of the credit, it goes to the team.
Oh, come on, you do. So thanks for listening to Monthly Market Roll. If you like what you heard, have any questions about the topics we discussed today, feel free to reach out to Waverly Advisors. Information on how to reach out us is in the description. You can get more info at waverlyadvisors.com, waverly-advisors.com. Thanks again for watching, and we'll see you on the next video.